this situation with SVB. It's right now. It's an evolving situation for us. It's Sunday evening in US time. The situation right now is that another bank, Signature Bank, failed, and the Fed stepped in and guaranteed full deposits for both Signature Bank and Silicon Valley Bank for everybody to get their money out on Monday, which is really positive after how the weekend went and how much screaming there was on Twitter. But more importantly, for this podcast is like, what was or is the relationship with Opendoor and how could this affect them? Tyler, do you have any information on that?
Yeah, so I commented about this on Twitter this past week when I heard about it. Um, I heard from one of my sources, uh, who I trust, that Opendoor has less than 1% of their capital in Silicon Valley Bank, and none of their critical business accounts are run out of Silicon Valley Bank, which was encouraging to hear. I mean, it's a moot point now because it sounds like no one's going to be missing their money anyways. Um, but I will say there is a historic relationship between Silicon Valley Bank and Opendoor, and a lot of the founders of Opendoor have recognized the idea that without Valley Bank support early on, there probably wouldn't be an Opendoor. And I think that's probably the case for a lot of um, disruptive and private technology companies in Silicon Valley over the past few decades who have partnered with Silicon Valley Bank. So I think overall, and maybe this is a separate topic. I mean, when you look into the cause of all of this, I mean, it really does appear to be mismanaged funds. But I will say it's a huge blow for the startup community, and it's unfortunate to see because Silicon Valley was very important for founders.
Yeah. Um, there's probably some other better podcasts to cover like what actually went wrong here. Um, it probably wouldn't have just affected Silicon Valley Bank, but as we see now with Signature Bank, and probably some other banks that are in a similar situation where they have very long duration but low interest instruments that wouldn't be worth the same as they were when rates were lower. So if everybody is going to get for their money, the bank would probably not be able to cover the amounts of time in time. I guess that's what happened here. And the spicy thing here is because in Silicon Valley, it's a lot about herd mentality. Everybody's running into the same sectors. If it's crypto or like AI, everybody wants to fund the same things. Obviously, if the big VC companies tell um, their the companies to pull out money out of Silicon Valley Bank, everybody else was also running after the money. So I think in the end, what happened on Friday is that 25% of deposits, like over $40 billion, got buried out, and that kind of resulted in whatever shock we saw after that. And the risk is that this could happen to other banks. So that's why the Fed stepped in and said, hey, all the deposits, not just the insured part, we will cover them. Probably the right decision.
I think just to double tap on that, and like you said, this isn't really the podcast to go into exactly what happened, but I think we can simplify this a little bit. I think there's two things that you look for security in a bank when you have a massive deposit, right? One is how much of it is insured by the federal government, and only banks really have that designation. That's part of what gives them power as banks, right? Um, but then the other thing is how much liquidity does that bank have? And the liquidity profile, like how much cash do they actually have available in the event that there is a bank run so that they could cover all deposits, right? So that ratio is really important. And I think a lot of the really powerful banks in the United States, right? Like the JP Morgan, the Wells Fargo, Bank of America, those types of companies, they have massive liquidity profiles because of the 2008 financial crisis. But for Silicon Valley Bank, you look at what happened in the past couple of years. you think Opendoor mistimed mortgage rates and interest rates, right? Like Silicon Valley Bank uh, was even worse, right? They bought 80 billion of mortgage-backed securities when interest rates were near zero, trying to get a 1.5% yield. And then the Fed raised interest rates 75 basis points 4 times, and then again, 50, et cetera. And you're in a situation where those $80 billion of assets are only gaining 1.5% when your consumer bank at like SoFi or whatever is giving you 4%. People start wanting more yield on their funds. And I think because Silicon Valley Bank didn't have very much of their assets insured by the federal government, number one, but two, really just didn't have the liquidity um, compared to their deposits. They were in a situation where a bank run made it very easy for them to go under.
Yeah, it will be interesting what the consequences of this are in the next 2 months. I mean, people are speculating from like maybe rate hikes will slow down or stop, which is obviously great for mortgage rates, probably, but who knows what else will break in this environment. Yeah, what is important to know is that you mentioned, as far as we know, Opendoor only had a very small amount of money in Silicon Valley Bank. Obviously, public companies don't disclose who their lending or banking partners are. This is not part of any rules. I don't think anybody discloses that. So we don't know for sure if any of their lending facilities are there or not. But there's a really great podcast that Dot Fraser did on the podcast, The Operator. I think the podcast is from Damien, who is at Founders Fund. It's a very, very great podcast that gives you a history of Opendoor's capital stack from like founding to post IPO. I think the podcast is from 2021. I definitely recommend listening to that if you're really interested in how the sausage is made on the capital stack of Opendoor. And Dot specifically said that like Silicon Valley Bank was not the right partner to scale and like really get to the right cost structure.
Right. And I think that's the other point that's important to double tap here is Silicon Valley Bank would be a great partner for a risky, unproven business model, right? Like a startup. And because of that increased risk, their interest rates, right? How much they're expected to earn on those assets is a lot higher than you might get at a different bank. And that's okay, perhaps, for software companies that are more early stage, mid stage, and Opendoor early stage. But for a company like Opendoor, which is looking for 10% gross profit margins maximum, capital efficiency is really, really important. And you want the lowest cost structure for your debt, for your access to financing. And Silicon Valley Bank is absolutely not that person, right? Like it's just a different business model. And so I think really important upfront for Opendoor, but it wouldn't make sense for Opendoor to have any significant or large proportion of funding with Silicon Valley Bank at this stage of their life cycle.
Yeah. And I think that's really important to state like that because I see a lot of speculation on Twitter where because of some headlines, people expect that the Opendoor is like 100% funded by Silicon Valley Bank. That's just not how this works.
It would make sense with what's been going on the past year if that was the end. But I mean, it's just not true. So,
yeah. All right. I'm glad we covered this. Likely what we should expect by next week, or maybe we shouldn't anymore because of the announcement from the Fed. But like on Friday, a lot of public companies filed an 8K, a announcement of material impact to their business. So we saw Roku announced that they had like $500 million in Silicon Valley Bank. We hope that we will see something from this from Opendoor as well, because even 1% if you're thinking about it on a quarterly basis, if that 1% would be gone, it would be kind of material. I think they would have until Wednesday to file this. They have a few days, but at this point, we might not even see that filing anymore because there is no material impact. So we might never know how much money Opendoor actually had in Silicon Valley Bank, but like it's unlikely that it's a big amount.
I don't want Opendoor leadership, right? Like the C-suite to tweet like Elon Musk. But it would be nice every once in a while to just get a few comment. You know what I mean? Can you imagine if Carrie just logged on to her Twitter with, she's like never on Twitter, but if she just logged on and she was like, hey, we don't have any capital in Silicon Valley Bank, or we had X percentage. And just the sigh of relief from the investment community. Wouldn't that be a great use of social media? You know what I mean? From a like crisis management perspective and investor relations. I just feel like some of these things, it would just be really nice if it was just solved, with 5 seconds of work in a bathroom break.
Yeah, I totally agree. I mean, there is obviously something to it that you don't want to be on Twitter, especially when you're Opendoor, because basically 90% what you get is like hate, and your customers are not there. There's nothing that really is great. There's no advantage to your business to be on Twitter every day as Gary Wheeler. But in these cases, yeah, just like FYI, something like that would have been helpful.
Yeah. As long as it's not, everyone relax, everything is fine, don't worry. I feel like those are the code words for like, get your money out right now, right? We've learned that from Silicon Valley Bank CEO and obviously Sam Bankman-Fried. They both did the exact same thing. And then the next day the company went under. Wild.
Yeah, I guess in hindsight, it's also good to just wait a few more days, and then it probably resolves itself maybe as well. But
Yeah.
some more communication would be helpful.